Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, July 30th at the market's close and at the month's close, too. We're heading into August. Well, the economy returned to its pre-pandemic level of output in the second quarter, according to gross domestic product data released by the Commerce Department. That's a rebound that came earlier than many expected, but the report also showed personal income dropping alongside a decline in federal transfer payments and the economy growing at an annual rate of 6.5%, slightly below the 7% expected by the U.S. Central Bank. And on that note, let's go on to three charts that could give us some insight into the week to come. First of all, we're going to look at a daily chart of the S&P 500 SPDR, SPY. We look at this always because it is the ETF or exchange traded fund that closely follows our benchmark index. And of course, you can follow the S&P 500 index. Certainly nothing wrong with that. But when we follow the SPY here as well, or at least and sometimes instead of, we can see volume here. There's no volume on an index. An index itself is not traded. But the ETF, of course, is follows the SPY or follows the S&P 500 very closely, and we can kind of see what participants are doing in the way of a lot of participation in the market or not so much by watching the volume on the SPY, and that can give us some good information as well. So that's why we watch the SPY. And today when I captured this chart, the SPY was trading at $438.51, which is about $43.85 on the S&P 500 itself. Now it made another new all-time closing high this past Monday, July 26th, at $441.02. So pretty darn good here. We're just keep making new highs. Now we can look back here and we can see that on July 20th, the SPY was sitting on the 50-day moving average again. And if we back up and look at this chart a little bit, and certainly if we went back further in time, this chart only goes back to January, we can see, and we've been noticing, of course, that the SPY is pretty much, except for a couple of days, it's pretty much been walking up the green line, the 50-day simple moving average, for quite some time now, certainly since January, the beginning of the year. And it just seems to have this inexhaustible energy from my lips to God's ears, because we certainly don't want to get too euphoric here. But it certainly is using that 50-day moving average as, we could call it a major trend line. And of course, now the 50-day is coming up to $427.37 today. So this is a near perfect uptrend here. We certainly can't argue with it. We have new resistance here at 442. We have support down here at 435. We're going the 20-day moving average, the red line. We'll call that minor support. And then the 50-day moving average again at 427 right now. Important support. Down here at maybe 425, we can see more support, price support. We have more here at 415. We have more down here at 405. And then we do have potential support at the 200-day moving average at $392.91. Now, what I'm going to say here, in the coming week, of course, we're going to see if the SPY can maintain its energy or not. Just let me add here, and I'm not a pessimistic person, but as a trader, I'm not too willing to give my profits back either. Okay, just if in the United States we have to mask up again because of the Delta COVID variant, please know, and you know this from the last time, this could put a little hitch in the giddy up of a lot of U.S. stocks. So if we keep getting more and more news about this Delta variant and it looks like we have to wear masks again, that kind of thing, again, will affect the market and probably not on the positive side. So you might want to just be a little extra careful here. I am going to take profits on some of my winners because I want to have a little dry powder here, and I certainly am not in the mood to give any of it back. So And you know what? If the market doesn't go down and the Delta variant, it doesn't become important, I can always buy some back, right? Okay, on to our next chart. Okay, so this one is the daily chart of the Invesco QQQ, symbol QQQ. As you all know, the Qs represent the NASDAQ 100, a major index in the market. Of course, top holdings include Apple, Alphabet, and Facebook, and Amazon. And today, with Amazon falling 298 points after announcing earnings last night, which is Thursday night of this week, after the bell, the QQQ did very well to stay as it did today because it's a big component in the weighted ETF, the QQQ. So the Qs did very well to stay aloft today as they did. And when I captured this chart, QQQ was trading at $364.57, and that was, of course, at the close today. So it is right now. The Qs is still sitting on its 20-day moving average, the red line. It also, if we look back here to July 19th, we can see that the Qs bounced off the 20-day moving average pretty well. It closed below it just teeny tiny bit, just a bit on July 19th at about 352, but it came down, bounced right back up, and then, of course, started pulling back in the last couple of days. This week has looked a little bit weaker. All the big techs came out with earnings, and as I said, Amazon did, and that was quite an announcement. One thing here I'll point out to you for the people who are technical analysts here, we have what is called here a negative divergence on the RSI, 14-day RSI. May be kind of hard for you to see if your screen isn't really big at home, but this indicator here is called the RSI, momentum indicator, 14-day it is. And what we have here is from that July 19th pivot point that I just pointed out, we had before that, the week before that, first week in July, excuse me, and before that, the QQQs have been climbing again to new highs, and then fell back down below the 20-day and then moved up to a higher high this week. Well, the RSI, if you look down here, made a higher high with the first high, but made a lower high with the next high that the Qs made, but the Qs made a higher high, the RSI made a lower high. That's called a negative divergence when the RSI is going in the opposite direction, so to speak, of price. So for any of you technical analysts out there, of course, which I am one, this simply means a negative divergence is that we may want to keep an eye on the QQQ, as that can be a slight negative announcement. So most technical analysts take this signal, a negative divergence, as a heads up to monitor price more closely. We do have resistance now up here at 370. Of course, we have more support potentially at the 20-day moving average coming at 362, down here at this low down here at 352. Then we have the 50, that comes over here. We have the 50-day moving average coming in at 349, offering potential support. And of course, on down to the 200-day moving average and these lows here at 320, 322. Hopefully we don't have to monitor that too closely. But at any rate, again, because of possibilities with the Delta variant, usually as well, August can be kind of a sluggish month. Not maybe as profitable as some other months. I am going to raise my protective stops on my positions, and again, I'm taking some profits right now. It just seems like a good idea. Our third chart today is a chart of the Invesco Solar ETF, the TAN. We've looked at this before. The TAN has 56 holdings, including Enphase Energy, SolarEdge, Sunrun, and First Solar. Yeah, we could go back into the text right now, but for the reasons I just stated, I'm going to stay a little more defensive right now for quite a few reasons. And I have been getting that way, as you know, in the past 2 weeks. So I'm thinking the tan here could be a good place to hang out. Energy usage is rising. Now, when I captured this chart today, the TAN was trading at $85.67. Now, if we look left on this chart to see what's happened earlier, we can see that in the month of January, of course, that was 2020, then, in the month of December right here, then January, then February, the TAN actually made a triple top here. Notice this 1, 2, 3 times, and you're out at about 126. Then it broke through this support line here that moved right into the 50-day moving average and fell pretty dramatically. Triple tops can be pretty brutal trend reversals patterns. So the TAN fell pretty brutally again down below its 50-day moving average, and then trended lower, and finally ending up here in May at the low here at about $68. That's when it hit its lows. Now, we can see here that in the short term we have a triangle. You can see where I drew the blue trend lines here. In the longer term, there are crayons, so we'll just take and we'll draw a line like this, and you can see where it forms a channel here. So if in the coming weeks the TAN stays above its 50-day moving average, and if the market stays positive, I will add a small, I'm going to add a small position to my trading portfolio with my initial stop at 78. Now, if the TAN rises above 90, above this resistance right here, I will add to my position, and of course by then I'll have a trailing stop. So if the market remains strong, you may want to keep an eye on the TAN in the coming week. And now, before we go on to final thoughts, please know that if you'd like to become a more successful trader, please check out my trader training programs. You're going to like my simple strategies targeted to swing trading, trend trading, bottom fishing, and more. And they can help you increase your gains quickly and easily. To see all of my online training programs, simply go to the link on this screen or simply click on the orange button below. And now, on to final thoughts. This week question of the week is, do I expect to make predictable profits when I trade? Do I expect to make predictable profits when I trade? Now, please know that traders set themselves up for failure when they, one, expect to make predictable when they, one, expect to make predictable profits from each trade, or two, expect to make equal income from short-term trading periods, or three, put predefined limits on gains they will take out of each trade. Here's an example. One of the worst things a trader can think of is something like, and believe me, I've heard this from traders, hey, today I've got to make $500 to make my car payment. Please don't think like that before you get into a trade. To maximize profits, please don't place expectations on a single trade. The market's trend and volatility ebb and flow. These are the main dynamics of the market. So to the market's pattern, you've got to add your pattern, your knowledge, your discipline, your experience, your plans. When you overlay your pattern on top of the market's pattern, the combination of those factors decide your profits, not whether you have to make a car payment or not. Far too many traders develop trading plans that are supposed to earn a fixed amount of money on a predictable basis. But they can get very disappointed because a lot of times it simply doesn't work that way. As well, the old 80-20 rule applies to trading as well other life events. For most trading systems, 80% of the profits are made on 20% of the trades. And I think if you'll go over your trades, you're going to find that's true. So please don't assign expected profits to a short time slot. Your goal is to become a consistently winning trader over time. Your goal is to earn more than you lose. The more proficient you become at choosing promising stocks and ETFs, like some of the ones we've just talked about, the more you stay on the right side of the market and the more discipline you exhibit, the more successful trades you will make and the more money you will bring home. Finally, please know that if you'd like to become a consistently winning trader, this is a great time to check out my trainer training programs. To see all of my online training programs, simply go to the link on this screen right up here, or again, simply click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.